Well, that rally continued apace, and March turned out to be a very strong month indeed. In fact, from the low points in early February, 11th of February to be precise, developed equity markets are up by 13%, so have recovered virtually all of the ground that they lost in that really very difficult period in the early part of the year, led by the US market, which was up by nearly 7% in March alone, so yet again leading the way. But most markets pretty strong, but actually the biggest returns came from emerging markets, which bottomed out in late January, and from the low points are up now by over 20%, a 13% return in dollar terms in March alone. So some very strong returns there. And it wasn't just equity markets that continued this rally, incidentally. We saw the rally continue over into the credit markets. So high grade credit up 2 or 3%, high yield credit up 4 or 5%, convertible bonds up 5% or so, emerging market debt strong. So a very strong period for risk assets. And indeed, if you look at where we are today, compared with the beginning of the year, you would think that not that much had happened. But in between time, of course, we had a savage sell-off followed by a very big recovery. In some ways, it was a reverse of the factors that caused markets to fall so sharply. We saw signs of stability in global growth. There'd been a fear that the world was tipping over into recession, hard landing in China, slowdown in the US, Europe and Japan. We didn't see that come through, in fact, and the data coming out of these economies has been, on the whole, not too bad. Not strong growth, but continuing sort of subdued growth. So I think that was important. Another very important factor was a big recovery in the oil price. The oil price started to recover from late January. In fact, its turn was exactly the same day that emerging markets turned, so a high correlation there. And of course, emerging markets have become highly dependent on the oil price. So many emerging countries are oil producers. So we saw that big turn in the oil price. That helped. Very importantly, it was yet another month when central banks were key influences on markets. The ECB came out with this long-awaited package in March of further monetary easing, cutting interest rates deeper into negative territory, extending the extent and duration of its asset purchase program very materially, and also providing increased facilities for lending to banks, which offsets the impact of negative interest rates on bank profitability. All very important. And then on top of all of that, the Fed came out with a pretty dovish statement. If you remember, at the beginning of the year, the Fed was saying there are going to be 4 interest rate rises this year. They've now cut that to 2. They've cut their longer-term interest rate expectations by 25 basis points. So generally speaking, dovish, very supportive for markets. And then finally, perhaps surprising most people, was weakness in the dollar. The dollar on a trade-weighted basis is down 5% now in the past month or so. That's always a help to commodity producers and to emerging markets in particular. So a combination of factors reversed of the things that had pushed markets down so aggressively has helped them to recover pretty sharply. It has had a big impact, and as I said, it's been highly correlated with the performance of emerging markets. Energy stocks are a big component of global stock markets. Oil is obviously a huge commodity that has a big impact on many individual countries. And what we're now seeing, having seen the oil price collapse, we are finally seeing evidence of falls in production in the US. At the same time, demand has been rising. And then, I think importantly, in recent weeks, there's been discussion amongst OPEC members and some non-OPEC members, in particular Russia, of a production freeze at current levels. And in fact, there's now a meeting coming up on April the 17th, just a couple of weeks or so away, where OPEC members will be meeting with Russia to hammer out some sort of a deal which could result in a production freeze. So there's a lot of market attention on that. But I think the key thing here is that we've seen a big slide in prices. We've seen marginal production falling. The high-cost producers are falling out. So production at the margin falling, particularly in the US. Demand continuing to rise. By the time we get to the end of this year, early into 2017, the supply-demand balance will be much more in equilibrium. And it looks to us as if we've seen the bottom of the market. At $27 a barrel, we think Brent bottomed out. And we're moving back towards the new equilibrium price, which we think is around $50 a barrel, likely to get there sometime over the next 12 months or so. Well, following on from that comment on bank shares, it's European banks that have been most exposed. European bank shares are down by 27% so far this year, so a really very sharp fall. And it's always worrying when banks are falling at that sort of pace. The problem in Europe, apart from this issue of negative interest rates that I've talked about and bank profitability on a longer term basis, is the fact that European banks have not fully recognised the size and impact of non-performing loans and loan losses on their balance sheets. It's a particular problem in Italy, but it's prevalent across a large part of the Eurozone. Unlike the US and the UK, which fixed its banking problem, recapitalised banks immediately after the global financial crisis, hasn't happened in Europe. We've said this a number of times, and it's coming home again in Europe. So there are some concerns about that. It needs to be fixed. That there is going to have to be a further recapitalisation. At the same time, we're beginning to see some concerns again about debt levels, government debt levels in peripheral Europe. People are worrying about Portugal, which is not very big. It's a bit bigger than Greece, but it's not very big. But nevertheless, it's an important indicator. At the moment, Portugal has a junk credit rating by 3 of the 4 world's rating agencies. The 4th one is about to review its rating of Portugal. If it downgrades to junk, that means Portugal will have junk debt status, and the ECB will no longer be allowed to buy Portuguese government paper. That will have important implications for that bond market there. People are beginning to worry and say, Portugal with 130% government debt to GDP, total debt possibly as much as 400% of GDP. Do we have another Greece on our hands here? Unlikely to be as damaging as that, but nevertheless, again, it's a bit of a worry. So I think we do have to get through some quite significant problems in Europe in coming weeks. And at the same time, of course, we've got the UK Brexit vote coming up in June. So Europe has a few challenges to overcome over the next few months. It looks like quite a cheap stock market, but in the meantime, I think we're going to get some volatility because of these concerns. Well, we've had a very strong rally from the lows. I mean, the sort of numbers I'm talking about are big rallies. And I think that a period of consolidation from these sorts of levels is due. And on the one hand, we've got some negative factors, sluggish growth and impact on corporate profitability, which I don't think will be very good this year. US profits are likely to be down a little bit. We've got continuing concerns about an overhang of debt that I've talked about. We've got this potential problem in Europe coming along. There's this issue, of course, of China's rebalancing and the way that plays out. It looks as if it'll play out reasonably satisfactorily, but it remains a risk. So you've got those sort of negative factors. Against that, you've got still positive growth in the global economy. And you've got, I think now we've seen the bottom in the oil market and commodity market, so the damaging effect of those very sharp falls is behind us and fully priced in. You've got the positive impact of lower commodity prices on consumer spending, which we are seeing. So you've got sort of, and of course you've still got these very low interest rates. I mean, you've got sort of a push into riskier assets driven by very, very low interest rates. To put it in perspective, something like $7 trillion of sovereign debt is trading in negative interest rates across the world. That's about a third of the total. So investors are being pushed still into riskier assets, equities and credit. So you've got those competing forces, and I think what we're going to see is a period of consolidation. And I think importantly, this volatility that we've seen in recent months is likely to be a feature of markets over the course of the next 12 or 18 months because of those competing factors. But having said all of that, I still think markets can make some progress, and I think the key thing is to stay invested, to be diversified, to remain diversified, to make sure you've got some safe haven assets in there, such as investment grade bonds, some gold shares, as well as the equity assets, and to be patient. And I think with all of that, there will still be reasonable returns from these levels, despite periods of pain and volatility, such as we saw in the early weeks of this year.